All right. All right, we're going to get started. How's everybody doing tonight? All right, good. So hopefully you're here to find out about Social Security, because that's what I'm going to talk about. So a couple of things before we get started. We're going to talk about the Social Security in general in terms of how the benefits work, but also talk about specific situations to think about or consider before electing Social Security. But I do have to do a little bit of my due diligence before I get started, maybe. In case you don't know, technology is not my strong suit. It's not working.
And it's on, correct?
Oh, yeah.
Gosh, maybe you missed it.
Am I doing wrong? What usually happens is she walks up and it works and does the same thing. It might be a battery issue, so I'll get started. I think I can move it with this if I can see the arrows.
The second one.
All right.
Just checking to see if it's the top.
All right, we're in action. All right, so a little bit of just things we have to go through. About myself, I'm part of Hammer Financial Group. Hammer Financial Group, we've been in the area since 2002. If you're familiar with Jalapeno's Restaurant, we're directly behind Jalapeno's Restaurant in Plum Creek Center there. And we do a lot of things in the area of Social Security maximization, but our focus is around just overall retirement planning, income planning, and tax planning, which I'll talk to a little bit and tell you a little bit about how Social Security comes into play there. If you guys need to use a restroom, if you're not familiar, it's just right across the hall. Go ahead. I generally speak for about an hour just to give you a timeline so that you know with it. I do enjoy questions. If you like questions, raise your hand. I'll reserve the right to stop questions if we start getting too long so that I can get out of here kind of timely, but I'll hang out. I won't run out of here in case you want to come up afterward. If you have phones, please silence them. If you have specific questions that you don't want to ask in the group setting, there'll be an opportunity to set up a phone call with myself or one of my other advisors if you want to just have a direct conversation with them. So we'll talk about that a little bit at the end. AFIA is a nonprofit organization. Their mission is to inform and empower Americans to take control of their finances by providing comprehensive financial education in communities nationwide. A little bit about how they're funded. They do fund through personal donations, tuition. They have some more advanced classes that we do out of the colleges, chapter sponsorships, and membership dues. However, since you were here tonight, you can actually join the site using our chapter ID, which is the 4411. I believe that's in your book. If not, go ahead and write it down. And you just go to the website, and they have some stuff there that, general information, periodicals, some calculators, and things that you might be interested in using. But it is more of a general website, just so you know. A little bit about the disclosure. Unfortunately, I got to read this. This is the compliance world that we live in today, so I'll get through it as painlessly as possible. But AFIA is a recognized 501c3 nonprofit charitable organization. We provide educational workshops and classes in both businesses and universities nationwide. The instructors are licensed and trained financial professionals with a minimum of 5 years of real-world experience in the field. We've been required to pass a series of training sessions on how to educate in a non-for-profit setting before becoming a coach and instructor with AFIA. The courses and workshops do not promote or endorse any specific products, companies. No selling is allowed. The educational workshops and courses are for general education. They're not intended to be construed as investment, tax, legal, or financial advice. Attendees should seek the assistance of a professional familiar with the course prior to implementing the ideas and strategies taught and discussed in the course. Hypothetical and/or historical returns contained in the presentation are for informational purposes only, and they're not intended to be an offer, solicitation, or recommendation. Rates of return are not guaranteed and are for illustrative purposes only. Projected rates do not reflect the actual or expected performance with any example or financial product. Past performance does not guarantee future results. They're a little redundant, guys. The presentation is not intended to be legal or tax advice. We can provide information, but not advice related to Social Security benefits. Clients should seek guidance from the Social Security Administration regarding their own situation. Presenter may be able to identify potential retirement income gaps and introduce insurance products such as annuity as a potential solution. Social Security benefit payout rates can and will change at the sole discretion of the Social Security Administration. For information, please direct your clients to the local Social Security Administrative Office or visit www.ssa.gov. So most of that is not going to pertain to the presentation. We are going to specifically talk about Social Security and how it becomes part of your overall retirement picture. Every once in a while you'll see this icon pop up, a little owl. That's just to let you know that in your books, what I'm talking about on the screen is in there. So just let you know that you don't necessarily be as diligent taking the notes. The books are for you guys to take home, so feel free to scribble whatever you want in them. But it's just to help point you to the fact that some of that information is already printed for you. So we're going to go through a lot of information. I don't expect you to leave here a Social Security expert. My purpose tonight is really to have you understand, is there more things I need to be aware of? Is there more things I need to find out about or inquire about before I make the final decision on Social Security? So just curious, how many people have actually started Social Security already? Okay, so we have a couple folks in the room that started Social Security. So we'll talk a little bit about that as part of the presentation as well. All right, so the reason why we feel Social Security is so relevant and important and why you need to take time to make the decision is for most people, it represents a very significant amount of their retirement. On average, it's about 40%. So because of that, it's important to make the right decisions. The other 60% is what you would expect it to be. You know, things like if you have a pension, if you have investments, if you have other sources of income, IRAs, 401ks, savings, things like that. But when we talk about it representing 40%, we want to make sure we're making the right decision because it can impact the way the retirement looks. There are multiple strategies, a lot of different combinations. I'm going to focus on 4 things tonight. I'm going to talk about your benefits, explain and answer any questions you might have about that, spousal benefits, divorce benefits, and widow benefits. So those are the 4 things that I'm going to hit on tonight in terms of topics. And we should be able to get through that in a relatively short amount of time, okay? So let's talk a little bit about the myth of the Social Security being bankrupt. I think most people have heard that the trust fund, right, is going to go bankrupt. It's going to go bankrupt in the year 2033. Let me talk a little bit about what the trust fund is, because I think it's important for you to understand when you're making a decision about Social Security. It's not going away. It's what they call pay-as-you-go system. So it was never designed that money that lands in the trust that comes out of your paycheck is going to provide benefits for you for the rest of your life. It was always designed as the people working, the money coming out of their paychecks would provide for the benefits of those receiving the Social Security. And when the Roosevelt administration started it, there was about 20 people working to every person receiving benefits. So there was this surplus. This surplus was what was landing in the trust fund. And until recently, there was more money going into the service or being taken out of paychecks than was actually being paid out in benefits. Last year, that changed. Now there's more being paid out in benefits than is actually being collected from checks. So without reform, they believe that that trust fund is going to be depleted, and if things aren't changed, then you'll be receiving 77 cents on the dollar. So the reason I want you to understand the significance of that, Social Security is going to be here, because a lot of times people will come into my office and they'll say, I'm going to get as much as I can, as soon as I can, before it gets broke and I get nothing, right? Now, I believe that they're going to continue to reform. I have no way of knowing for sure, right, if they're going to continue to reform it, but we've already seen it. How many of you remember that you were going to get your full Social Security benefit at age 65? Any of you get it at age 65? No, it's 66 in some months or 67, right? So that was part of the reform. It used to be that, the first $27,000 of your income was subject to FICA. Now it's over $140,000 that's subject to FICA. And they're going to continue to adapt for the same reason I started with. It represents such a large portion, and if that income gets reduced for the retired class, somebody's going to have to pay for it. And we know the government doesn't have the money to do it. So I think they'll continue to take the money from the people working, figuring out ways to adjust the program so that it survives. And I just want people making that decision based on the fact that it's going to be here and that it's not going to be here. because it will be here in some form, and I think they'll continue to adapt and adjust and make those modifications so that the benefits continue. And in fact, I have very little fear that the people in this room are going to be impacted by the changes that are going on in Social Security, because they'll continue to do those reforms. But I always tell people, when you do the math, right, they come in, say, Greg, I did the math. I would suspect that most of you in the room have done the math, right? It's age 79 or 80 before I break even, before I get all the money if I started collecting at 62. So what I want you to think about today, as we're going through some of the ideas around Social Security, forget the whole dollar analysis, because it doesn't work for several reasons. One is, it's not about the whole dollar. It's about the net dollar. My wife doesn't give two hoots about what the gross check is, right? It's about what gets deposited in the account, what we get to keep. So we're going to talk about how taxes can impact your benefit. Also, cost of living adjustment is very, very relevant. Cost of living adjustments are going to have a bigger impact on larger dollar amounts than they are on smaller, which is going to shrink that quote-unquote break-even curve. But also, I want you to think about Social Security in terms of how it might address some of your concerns, some of your priorities, some of your goals. So I'm going to use myself as an example. I'm pretty confident that my wife is going to outlive me. She's a couple years younger, but more so, gals tend to take better care of themselves than guys, right? One of my concerns is how much money she would have after I pass away. So likely my plan is right now to defer taking Social Security till likely 70, as long as my health allows me to continue to work, right? So that she would have a larger benefit should I pass away, because the survivor benefit is going to be the higher of the two, right? Now, there might be situations where health says, I can't start collecting it, or I need to start collecting it, right? So those are all different things that would be addressing concerns or priorities that you have. So talk about or think about the way Social Security could help you resolve some of those issues. If I have a lot of assets and pre-tax assets, you may want to defer collecting Social Security to do tax planning. Because once you start collecting Social Security, you increase the expense, the tax expense of all those assets laying in those pre-tax type accounts, like IRAs, 401ks, 403bs, 457s. So I'm just giving you some examples to start thinking a little bit differently. Now, Social Security by itself was never meant to be the entire solution, and it does have inherent flaws. You know, the very first person to ever collect a check was Ada Mae Miller. She put about $23 into the Social Security system and then proceeded to live to age 100 and collected close to $24,000. So inherently, obviously, some challenges. One of the challenges there, people are living longer, right? When this whole program was designed, and the reason they needed to adjust it, the life expectancy wasn't nearly as what it is today. In fact, the percentages we'll talk about of living beyond age 90 once you reach 65 are very significant. And a lot of people are concerned about, will I run out of money, right? And if that's a concern, that would be one thing that would tip you towards potentially collecting at a later time or delay collecting it. And all these sources are, what other sources do I have, in connection with Social Security? If somebody doesn't have a lot of other resources, we're generally going to tell or recommend to lean towards deferring and continue to work, because it's going to increase your income substantially. If you have a lot of other resources, then there might be things you can do. When you retire, when you start collecting Social Security, are not married events. You can retire and still defer Social Security if it makes sense. But the biggest thing that I tell people, there's no one way or absolute way I can tell you the best way to collect Social Security unless you're able to tell me the exact day you're going to leave the earth, right? Because ultimately it is a math equation. And depending on how long you may live is going to directly determine, when I should collect. If we knew it was going to be a short life expectancy, then absolutely the math says collect it early. So those are some of the things that are going to be uncertainties when you're going to collect Social Security. Does that make sense? Okay. So let's talk a little bit about the number one question that people have, and it's generally about, will I outlive my assets? What I generally find is people come into our office, there's a natural fear to spend money. They're frozen. because they don't know the what-if questions, the answers to the what-if questions, all right? What if I live long? What if inflation goes up? What if the market's volatile? What if taxes change? So there's a general tendency or fear to spend money, so what they end up doing is they end up not spending it in what I like to refer to as the go-go years, right? The years that you physically want and can go do things. Then you enter the slow-go and no-go years with this money that you could have spent in the go-go years. So what we want to do is create clarity in the planning aspect to create confidence for you to spend money. So those are some of the things that we're going to look to integrate when we consider the best ways to consider collecting Social Security. And 42% of the people fall into that area. Now, a lot of things to consider when you're looking at how my retirement plan should be set up, because always the questions we get are, where should I take from? What are some of the things I should do? What are some of the tax mitigation or tax planning things that I can consider? But all these questions all come down to, what is coming in and what is going out in the budget, something that the government has been eluded by, right? We've never been in a balanced budget for years. It's all about that spending. So, oops, not too fast, hit the wrong button. Will your expenses increase faster than your income? How do you feel about market volatility and how that can impact your lifestyle? Are you guys familiar with sequence of return risk? Anybody ever hear of that? So sequence of return risk has to do with the volatility of the market, right? If the market's down, we're not supposed to what? Take money out, right? Because we're locking in losses. So during the accumulation phase of our life, it's generally not a problem because we have income. But once we get in the distribution phase of our life, we can't just say, I'll wait 3 years for the market to recover before I start taking money, right? So how do we plan around that? How will I pay for my health care costs? How do I balance the needs of my family? And how much do I have now? So as you're going through that process, it's important to understand your situation. What's the matter, Earl? You look a little down. Well, according to statistics, I have a better than 50% chance to live into the age 87. Well, what's wrong with that? Can't afford to live that long, right? So what we want to do is just gain clarity in terms of how to live the way we want to maintain our lifestyle. You hear a lot of people talk about budgets. I'm not a big budget fan. I don't think you want to retire and be on a budget, right? We need to understand what the lifestyle need is, and is that possible? And then what combination of things would help produce a better probability of it. See, there's a lot of things that are called variance in the outcome, things that can change. There's not this blueprint that they give us and say this is everything that's going to happen in our life along the way. So how do we shrink that variance to create a more predictable outcome so that we feel good and confident about spending money in the go-go years, right? So let's talk a little bit about what your Social Security benefit it will be, understanding what your options are, and some things to consider when you're talking about ways to maximize that benefit. Now, the statements, you guys have probably seen these. For a while, they didn't send them out. Then they gave them a facelift. This is what they look like right now. So there's two numbers or two terminologies that you want to know. It's called FRA, full retirement amount, or PIA, primary insurance amount. That is the same number. They switched the name of it because of the age bracket changes as to when people collect, but that number is important to know because that is the number that will drive your benefits, spousal benefits, divorce benefits, and widow benefits. So that number, if you're looking at, hey, what are some of the things I need to consider, is a number that's going to be very relevant, a number that you want to know. So on your statement, it's the number that coincides with what they are telling you your full retirement age. So your full retirement age is based on the year that you were born, right? If you were born after 1955, 1956, you're 66 and 2 months is what they deem your full retirement age. So each year coincides with that bump. You got 2 months, 4 months, 6 months, all the way up to 1960, which your full retirement age that they are telling you would be acceptable is age 67. So we'll talk about that, but at full retirement age, you're able to receive your full benefits that you earned. So this statement summarizes everything. It talks about the contributions that you made, the contributions that your employer made. So glance at it and make sure that the numbers make sense, especially if you were a contractor, if you were self-employed. It's not uncommon to see misrepresentation in that data, which would mean that your benefits may not be accurate because they didn't record them properly. So if you have numbers that are off, you can go in and say, here's proof. I had these types of income in this year. Adjust it. It's not very often, but we do see it sometimes. So the primary insurance amount that I talked about is the number that they calculate over 35 years. So let me explain what I mean, because often people get confused with if I retire or if I want to work part-time before I fully retire, how does that impact my Social Security benefits? And a lot of it is like people think about the old pension terminology. It's the average of my last 5 years, that they take, and then I get a pension retirement amount. That's not the way Social Security works. Social Security is based on your best 35 years adjusted for inflation. It's the average monthly earnings adjusted for inflation. So what that means in English, if you worked 35 years at a job that consistently increased with inflation, it was kind of a consistent income for the field you were in, and you decide to retire at age 62 because that's your 35 years, or you decide to go part-time, it's probably going to impact your benefits very little because you have 35 years. If you had gaps, or where a lot of families, that one of the spouses may have taken time off to raise the kids, and they had maybe 10, 12, 14 years where they didn't work, and at age 62 they only have 20 or 22 years, well then working to age 67 is going to make a bigger impact because you're replacing zeros. Does that make sense? So as you're looking at this, it's all an estimate until you get to age 62, unless you're disabled. The reason they have the estimate is for the disability. They assume that you would continue to work. So if you become disabled, that number that's on your statement is what will drive your disability benefits. I'm not going to go down that path because disability is a lot more involved, right? But once you reach age 62, they actually calculate a benefit amount for you. And you can go on the website, and there's calculators on that website. Now, has anybody actually gone in yet and logged into their account? Okay, quite a few, good. You're going to need to. Everybody's going to need to. Their plan before COVID was to get rid of all the personnel in the Social Security offices and get rid of all the brick and mortar. So anything that you're going to need to do from a servicing standpoint, you're going to end up doing from that website. It sounds like they're looking to escalate it even more and get rid of more people within the Social Security Administration and put it more on the individual or the couple, to sign up for these benefits. Even when I moved mom and dad out here a year ago this last fall, I had to set up accounts for them. At 80 years old, I had to set up an email account with this dual authenticate. I can never say that word. Somebody, there you go. Thank you. And secret password to get them in and log in, just to be able to change their address and change their bank info, because they would not do it over the phone for me with mom. So get that account set up. It's a secure account. They're going to ask you about 5 or 6 questions. I can't remember exactly what it was. All questions that you should know the answer to, but don't be alarmed if you forgot the answer to one of those questions, because they might ask you about where you carried your first mortgage, or what was one of the cars you owned, or one of your addresses. If you answer it wrong, they'll lock you out for 24 hours and you can try again. But once you get it set up, you can create your own personal account number. But on that site, you can go in and say, hey, if I retired here and then I had a reduced income or no income, how would that impact my benefits versus working straight through? And you can see what kind of difference it would make. But it's important that you understand what your benefit is and what you're eligible to receive as you're going through this process. So that PIA number, or full retirement amount, is that number that you're eligible for at your full retirement amount. And that site is ssa.gov/my account. Just go ahead and create the account, and you can get any information that you need there. I'm going to talk about some different terminologies: eligible versus entitled, the windfall or the government pension offset, cost of living adjustments, claiming age, working after you make your claim, taxation, spousal benefits, and some common claiming strategies. So I'm going to rapid fire this stuff, you guys. Again, if you have questions, I tend to talk fast. Slow me down. Raise your hand. Make me repeat something. But I'm not having the expectation that you're going to retain all this on 100%. I just want to have you go through the class tonight and say, there's a couple things I jotted down that I need to find out more about before I make my decision. So let's go through some of these. What is an eligible worker versus an entitled? So an eligible worker is the one that's accumulated the required number of credits. You guys know that's 40 credits, right? You can earn up to 4 credits a year, so it's a minimum of 10 years of work to accumulate the 40 credits. You can also qualify on a spouse. So if one spouse didn't work, stayed home, raised the kids, even if they didn't raise kids, they can qualify for benefits based on the spouse's work records. But you have to be eligible by those 40 credits, and you have to be at least age 62. So once you turn 62 outside of disability, you're eligible to receive your benefits. An entitled worker is one who's applied for benefits whether they're receiving them or not. So the significance of being entitled is your spousal benefits would not be eligible unless your spouse was entitled. So there's a new thing called deemed filing, which we're going to talk a little bit about too when we get to spousal benefits, that has changed the way spousal benefits work. So you need to be eligible, entitled to be receiving benefits. I want to talk a little bit about the windfall provision. So windfall and government pension offset, if you were involved with a federal pension. So my dad worked for the government. He had a federal pension. He worked a few years in industry, about 13 years in industry, and then he worked where he was funding a pension through his paycheck. It was going into a private pension, wasn't funding Social Security. That's a federal pension. There was a windfall or government pension offset. You've seen it with teachers, public workers. You've seen it with a lot of the government's post office for a while. If you were a part of that windfall offset, what would happen is you wouldn't be eligible to receive those benefits that were stated on your statement for two reasons. One, you didn't technically have your 35 years, right? And two, they were going to reduce it because you were receiving this federal pension. They have eliminated that windfall and government pension offset. So if you were subject to that, or you thought you were going to be subject to it, as of the beginning of this year, they have now eliminated that provision. They're supposed to retro back for anybody receiving benefits back to January 1st of 2024. So pretty significant if you're receiving a federal pension. You just got a pretty big pay raise, and you'll be eligible to receive spousal Social Security benefits too, because that was one of the big deterrents. If a spouse passed away, even if that was the higher Social Security, you couldn't retain it under the federal pension. So they have eliminated that provision. Cost of living adjustments. They have cost of living adjustments on your benefits, and it's important to consider. Remember, I talked about the math, right? Everybody does the math, age 79 before I break even. Well, that's without cost of living adjustments. If I delay and get cost of living adjustments on a larger number, I'm going to get bigger incremental dollar increases than I would if I started lower. So keep that in mind for two things. One, in terms of the analysis of when I get it, if I delay from early retirement age to full retirement age, or retirement age to 70, which I'll talk about, those are pretty significant differences in income when you add a cost of living in the way that they pay it out, which I'll talk about in a little bit. But you should also consider cost of living when you're creating your financial retirement plan, your income plan. Things today are going to cost more later. Right? So as you're beginning the planning, you need to understand, okay, how does inflation, as an example, impact it? Now, it's easy to have recency bias because inflation has been not fun the last couple of years, especially like if you go to the grocery store even, right? They've tried to buy stuff, it's insane, you know, what you need to pay for stuff now. But we've averaged about 3.6% over the last several years. So you do want to factor that in as you're doing. We use at least 2.5% in any cost of living adjustments when we're doing retirement planning. So keep that in mind. Now I'm going to talk about claiming age. Now most of you guys, this is going to be familiar language and familiar information, but I'm going to go through it anyways. So the earliest you can collect is the month that you attain age 62, and it would be for that entire month. So even if you were born at the end of that month, right? The full retirement age is, as I explained right now, it's a range. It's from age 66 to 67, depending on the year you were born. So 1955, you're 66. 56, you're 66 in 2 months, and so on all the way up to age 67. And then at age 70, that's the maximum amount of your benefits. So in this delayed, which we'll talk about, delayed retirement credits, there's never going to be a reason to collect later than age 70 unless you have charitable intent for the IRS. So that's the deadline, right? So there's pros and cons. Some of them are pretty obvious. 62, the biggest pro is we're receiving money early. So a lot of folks in a situation that had physical jobs, their bodies are starting to break down. They can't continue to work. Some of their pensions are tied to what they call Social Security kickers. They're often going to be more on the early collecting side because they have to, right? That's a necessary resource on that at that point. People that are going to continue to work, they might push more towards the later. But the pro is you'll be getting checks earlier, right? The cons are it is going to be the smallest check. The reduction is about 30%. I say about because it's different with all those different months that people become eligible. So if you collect at age 62 and your full retirement age was 67, you are choosing to give up 30% of the benefits that you earn. So just keep that in mind. Doesn't mean that you have to wait, but just understand that you're giving up a pretty significant amount. If you earned $3,000, you're probably giving up close to $800 a month in benefit, which is significant dollars. Also, if you are going to continue to work, a lot of people like to double dip, right? I'll work and collect Social Security. Well, if you file early, and we'll talk about this in a little bit, they restrict how much you can earn, not have an income, but earn. You could have pension, you could take money out of your qualified retirement plans, you can have interest, dividends, all that stuff. But how much you earn, how much you trade money for time is restricted. And we'll talk about that in a second. Now, if you go to full retirement age, you get 100% of what you earned. So that PIA number or that FRA number that you're looking at will continue to adjust for cost of living till you turn full retirement age, but you would get 100% of that. There's no penalty if you're employed. So a lot of people start to double dipping at this point, right? They want to build up some extra cash, they're going to continue to work, and they're going to collect that check in connection with their salary. The big con, of course, you don't have any benefits from 62 until that full retirement age. So for some people, it's not feasible. Just not possible because of their situation. But for other folks, it's not going to make the impact if they're going to continue to work. Likely that's something that they can do and they can reap the benefits, or they might have other resources, right, that they can tap into. And we'll talk a little bit more about that in a bit. Any questions on that? Yes?
Have you heard this premise that you can take your Social Security benefits early and then invest them, and then by the time you hit that full retirement age, you would have made more through the investment than you would have gotten otherwise by just letting it sit there?
I've heard the premise. I think it's impossible.
Okay.
Just simply because of the way it works. So if I'm collecting early, what I would have to say, let me just give you an example so I can tell you why I think it's almost impossible. So if I were to collect at age 62 early versus age 67, on average it's probably $800 to $1,000 difference. Let's just look at 800 for a second. So the average draw amount, they would say, would be about 4%. So you would have to save at least $200,000 to say that I can feel pretty comfortable about adding that extra $800 a month where I wouldn't have to worry about it running out of money. So trying to save $200,000, collecting $2,000 a month or $24,000 a year over 5 years would have to be a very, very high rate of return, and then maintained high rate of return to continue to generate that $800. So to me, the better investment would be, if I don't need it, wait, because it's guaranteed. Right? I don't have to take this money. I don't have to subject it to taxes, because here's the other problem. If I'm collecting it at age 62 and I'm trying to save money, I'm probably still working. So now my Social Security benefit's probably taxable. You're probably not getting the $2,000.
Probably a higher tax.
Yeah, everything goes bad. Everything goes south. So typically, I've never seen a scenario where I would recommend that, just because the math, and I'm a math guy, you guys. I'm an applied math major from Yale. Right? So numbers mean a lot to me. Math doesn't lie. And I've never seen the math that would prove that as a path that would make more sense than just delaying and getting that guaranteed income. Does that make sense? All right. But I hear that a lot. It's out there a lot, with it. Do and invest the difference and try to get more income. Now at age 70, the value there, I already kind of hinted at it. It's the highest check. So every year that you delay past your full retirement age, you get an additional 8% credit on top of the cost of living adjustment. So if you were at $3,000 at full retirement, you're probably $4,000 at age 70. So very, very significant. And again, the math would be the same for me. $1,000 a month, now I gotta have $250,000 saved somewhere after taxes, right? It's probably not, and you have to have performance to get to the point, where you need to do it, where I can guarantee that that's a check regardless of performance, right? Anybody ever concerned about market volatility, right? What happens when the market goes down to your Social Security check? Keeps coming, doesn't it? Regardless, up or down, so we call it promise-based income. So a lot of people that have more of a lack of comfort with volatility in market and investment, we would tend to recommend them delay Social Security a little bit more because it's a guaranteed increase in income, right? It's promise-based. You don't have to worry about the market volatility. Then you don't have to be as aggressive in your portfolio, and you can reduce the volatility. So I'm telling you how we think, right, in doing this. It's not just about, hey, let's scribble the number on a notepad and see where the dollar breaks even at some age, which is going to be right at or around 79. It's about all these other factors that can help give ease, comfort, confidence when you're talking about retirement, right? If I have $2,000 a month coming in from Social Security versus $4,000, you're much more likely to spend a higher dollar amount every month in retirement because you have that $4,000. Now, again, that's not necessarily the path for everybody. I'm not saying everybody should delay. But those are some of the things that you got to think about. Hey, what are my main concerns, my priorities? What are the things I'm trying to address in my planning process? And should I consider how Social Security could potentially address those concerns? Right? Okay? But there are no benefits from age 62 to age 70. So a couple important things. I mentioned this already. There's something now called deemed filing, and it has a lot to do with spousal benefits. But deemed filing says if you are going to file early for your benefits, you must file for all eligible benefits. So you would have to file for your benefits, and if your spouse is entitled, you'd have to apply for spousal benefits. This goes back to the old adage, hey, I'll collect mine first and then switch to 50% of my spousal's benefit at age full retirement. That's not how it works anymore. So they eliminated that provision in it. So you have to file early. The biggest thing is if you file early, understand that you will have a reduced benefit. You can't switch over to a higher benefit from a spousal benefit later down the road and recapture everything that you were filing earlier. So it's one of those adjustments they made in the Social Security system to help extend the benefits. They also eliminated the file and suspend provision. So a lot of the folks that you might be asking about Social Security that did it, 6, 8, 9, 10 years ago, drastic rule changes. So just understand that what they did was probably available, but is unlikely available for you today. Voluntary suspension, once you reach full retirement age, you can suspend those benefits and you could begin gaining the 8% credit on it. So we'll talk a little bit about that as a claiming strategy, but essentially, let's say you collected early, figured out that's not the best route, or you had an opportunity to go back to work, make more money, doesn't make sense to keep collecting it for whatever reason. Once you reach full retirement, you can say, I'm going to delay it. Now, you won't recapture a lot of the stuff that you had lost because you filed early, but that income would then grow at 8% plus cost of living adjustment for the next 3 years that you delay it. It's a voluntary suspension, so you can increase your income substantially. So when it comes to retirement, what should we do? What should we consider? And again, every situation is going to be different. Some people have other resources. Some people have limited resources. Some people have pensions. Most people don't have pensions. So depending on what your resources are is going to directly determine what would be the potential path that would make the most sense to optimize your retirement plan. Now, once you start collecting Social Security benefits, there's two things that I'll talk to about Social Security. There's whether or not it'll be taxed, and then whether or not you get to keep the dollar amount that you're eligible for. So what I mean by that, if you collect early, at age 62 you're eligible. If you start collecting early, until you reach full retirement, you cannot earn more than $23,400. You could have a pension. You could take money out of IRAs, 401ks, 457s. You can have all the income in the world and everything. You just can't go work for it. Right? I call it trading time for money. If you have a job or you're doing contracting work, your efforts are producing an income and you earn over $23,400. Do you have a question?
Yeah. Does that include, like, if my wife takes her benefit, does that include my income?
Nope. You could still work. You could still work.
So we're not under that 23,000.
Right, you don't have to be, it's what you do. It's all about what your filing is. So if your spouse is under 23.4, she's fine with it, no problem whatsoever, but the other evil will rear its head, which is taxes. I'll talk about that in a second. Because if you're still working and having high income, it's going to be subject to taxes, which I'll get into. But if you earn over that $23,400, every $2 you're over, you don't get the dollar of a benefit. So if I was 10 grand over, my benefits are reduced by 5,000. If I'm 20 grand over, my benefits are reduced by 20 grand. And the way they do it is when you file for benefits early, you have to fill out an application every year. You have to tell them what your income is going to be, and they don't spread it out over the year. They don't give you the first payments until that amount appears. So let's say you were getting $2,500 a month, and they said your reduction is $10,000 because you're 20 grand over, you won't get a check for January, February, March, or April. So you'll have 4 months with no income. So, I mean, I'm not defending them, but that's just what they do, so that you know. So it's not like a pro rata distribution. So understand that there are limits, and the complication of that is, let's say you honestly didn't think you were going to make over that $23,400. A job changed. I earned more money, I got a bonus, I'm going to take the money. At the end, they will take it from you when you do your taxes. Because the tax return is the balancing of the books, right? Everything happens on the tax return to balance the books. So we'll talk a little bit about that too as well. Now the full retirement age, this is where that double dipping comes in. If I turn 67 as an example, that's my full retirement age, I can make as much money as I want, and I can go ahead and still collect my Social Security. Now, it's going to be taxable, but I can collect it. Now, if I turn age 67 during the year, let's say it's July 1st, I turn 67, then that first part of the year, you can make more money, but you're limited. If it was January, it's $62,000. If it was December, the entire year, I can make $62,000. It's a bigger limit because you're closer to your full retirement age. But if you were July 1st, you could start collecting, you know, that January, as long as you didn't make over $62,000, you're filing early, you're good, right? But every $3 you're over, $1 has to go back. So pretty much when you get that close, it's usually not a hindrance for somebody collecting. If your income's much higher than that, just wait 5 more months and collect July 1st, would be my simple recommendation with it. But they do give you a lot more allowance there, okay? That's confusing too. Yes?
I have a question. Say your full retirement age is 67, and you retire at 65. Okay, take your Social Security at 65. Is it a percentage of that? How much you can make?
So you can do pro rata if that's what you're asking. Like I retired at age 65, and I want to work part time. You can pro rata, so that would break that down monthly. Is a way. I think that's what you're asking, right? So if I had $23,000, you can make about $2,000 a month part time. Right? They're going to balance the books at the end. So if you worked 4 months and made $20,000, they're not going to tell by that W-2 or the 1099 that it was all made in 4 months. So they're just going to look at it as a year calculation. So ultimately it comes down to the year. But where the pro rata comes into play, let's say you turn 65 July 1st, in my example, and then you wanted to work part-time and just retire and start collecting. They'll consider the pro rata for July, August, September, October, November, right? Because you may have made more in the beginning. But when you retire, you say, I am retiring and I'm going to start collecting Social Security, they won't use those months that you weren't collecting Social Security. Does that make sense? Make sense, guys? Okay. All right. And then, of course, after full retirement age, you can continue to earn. All right. So let's talk about provisional income. I mentioned 2 things when it comes to Social Security. One, if I'm collecting early, they could take some of it away. Now, once you're collecting it, the second thing to understand is, do I get to keep all of it from taxation? So when you start collecting Social Security starts off on the inside of your tax return, okay? Then based on this provisional income, which I'm going to talk about, it determines how much your Social Security goes from the inside of the tax return, the non-taxable side, to the right taxable side of the return. So what is provisional income? You know, the IRS doesn't like to keep anything simple, right? The more complicated, the more confusing it is, the less likely people are going to ask questions. So it starts off once you start collecting Social Security. Now this is where it will be, if it's just one spouse collecting, then it's one. If it's both Social Securities. It doesn't matter who's working, who's not working, whether they're out of that provision, all that stuff. They take the total amount of Social Security that you're collecting and they cut it in half. So they take 50% of it. Then they add it to everything else that shows up on the tax return. Wages, pensions, dividends, interest, even tax-free interest. There's one thing that doesn't count against provisional income, which I'll speak to in a little bit, and that's a Roth IRA distribution. That's why Roth conversions are such a big part of our planning and what we do out of our office, because Roth conversions trump everything when it comes to taxes. They're one of the best vehicles that exist. So wages, all this stuff comes in, and then it goes against thresholds. And the thresholds are different if you're filing single or if you're filing married joint. And yes, I agree, if you're single, the tax code is not fair. It doesn't cost half to run a household, but they don't treat it the same. So these thresholds, if we look at married filing joint, the first threshold is $32,000. If you exceed that $32,000, then 50% of the amount you exceed it represents the amount of your Social Security that goes from the inside non-taxable to the taxable side. So let's say I was over that threshold by 10 grand, and I was receiving 40,000 of Social Security benefits. I'm over it by 10 grand, 5,000 of my 40 now becomes taxable on the right side of my return. Still getting 40, but now only 5's taxable. So this is a sliding scale. It continues. The more you begin to progress up in income, the bigger the distributions you take, the bigger the amount of the Social Security that becomes taxable. The second threshold is 44,000, so it's no longer 50%, it's now 85% that it's over. If I was over 10 grand, then 8,500 of my Social Security becomes reportable. So there's three types of tax rates that you need to understand. One is what they call your effective rate. Easy to understand, because all you gotta do is look at your taxes, look at the total amount of taxes you paid versus your total income. That's your effective rate. If I paid $6,000 of taxes and $100,000 of income, I have a 6% effective rate. The standard rate is the table by how your taxes are impacted, right? They have all those different levels, right? Nothing. That's why the IRS code is so complicated, the federal tax return, because there's nothing really easy to explain. There's so many things that can change it. So it's all those different levels. I get my standard deduction for nothing, then there's the 10, then there's the 12, then there's the 22, then there's the 24, then you get into all that crazy stuff, right? Then there's what they call a marginal tax rate. The marginal tax rate is the cost of the last distribution. So I take out a marginal distribution, or I take out a distribution during this scale, I might be in the 12% tax bracket, which would only cost me $120 on a $1,000 distribution. But if I have a $850 of my Social Security that wasn't taxable, that becomes taxable, well, I got to pay taxes on that $850 as well. Anybody have a guess as to what the highest marginal tax rate is today? 50%. This is where planning and tax mitigation really becomes a part of the process, right? It's about understanding how to minimize overall lifetime taxes. And that's really the area that we focus a lot of our planning on. It's about reducing those taxes. We've accumulated money, and the challenge is a lot of people think the money's all theirs. But in a lot of situations, you have a partner, don't you? Whether you want to admit it or not, you do. It's the IRS. You know, you just need to understand how I can minimize how much of that money they're going to get. So the taxation part is a very relevant part when it comes to planning. So there's a lot of different ways to reduce those taxes. I'm not going to get into a ton of them right now today. I just want to continue. For some reason, I'm running long. I must be long-winded today, so I'm going to keep rolling. But doing things to, one of my favorite is Roth conversions. You know, understanding how a Roth conversion can impact your lifetime taxes, because it reduces a lot of things that I'll speak to. So I want to talk a little bit about some spousal benefits. So spousal benefits are based on the other spouse's full retirement benefit, not when they collect, right? Because a lot of people say, if my spouse collected early, does that reduce my spousal benefits? The answer is no. You're going to earn a percentage of that full retirement amount, whether they collected at 62 or age 70. But it's going to be determined by the age that you collect, right? So if you're a married couple regardless of when your spouse collected, if you collect early and you're wanting to collect spousal benefits, it's going to be reduced for the 50%, from the 50% you're eligible to. But you're also going to have to do deemed filing. Remember deemed filing? Deemed filing is now that you need to collect your benefits first. So a lot of the confusion when it comes to spousal benefits is this 50% number that flies around everywhere. It's been flying around forever. But that 50% is only if, you'll only get the 50% if in fact you wait till full retirement age to collect your benefits. That's when you'll get the 50%. Now, the other part of it is you're eligible for up to 50%. We have changed the way people work. Most families have 2 working spouses right now. So if your full retirement amount, your PIA number is higher or more than 50% of your spouses, with deemed filing, you're not eligible for a spousal benefit anymore. Because you have to file for your benefit first, and it's more than 50%, so you will not be eligible to collect a spousal benefit. Right? That's what deemed filing did. It reduced that opportunity to collect and let yours grow. So you reduce, again, before full retirement age, you're going to see a reduction of your benefit. I say that several times in a presentation because it's resounding, right? If I collect early, your benefits will be reduced. Now, if your spouse hadn't collected, then you're still eligible to receive that difference. A simple example, let's say one spouse has $3,000, you have $1,000, $1,500 is the 50%, right? You file for yours early. So instead of $1,000, let's say you're receiving $700. Just keep it simple. We don't need to do any complicated math. Your spousal benefit is not the difference between $700 and $1,500. Your spousal benefit is the difference between $1,000 and $1,500. So if your spouse wasn't entitled and you can't collect that $500, you can wait, and when the spouse files, you can get that $500, but you'll never recapture that $300. But if your spouse is entitled, you need to file for that $500, and that $500 gets reduced by the same percentage. So just make sure you're understanding the reduction if you're filing early, okay? In the event of divorce, very, very similar as if you were collecting as a spouse if you were married for at least 10 years, right? If you were married for 10 continuous years, and it does have to be continuous, people remarry the same spouse, but not in time. Right? So that has to be part of it. You have to remain unmarried. If you get married again, you don't lose the opportunity, you just go to spousal benefits. So you go to your current spouse, and you're not eligible to receive the ex-spouse. Does that make sense? Okay. And your ex-spouse has to be receiving Social Security, but you can also independently entitle. That spouse can't say, I'm not going to collect just so that my ex can't get any money. Okay, so if you can independently entitle yourself by reaching both of you at least age 62, your divorce has been final for at least 2 years, and they don't have to be receiving benefits to be eligible. Survivor benefits. So this is one that breaks all the rules. If you are unfortunately a widow, understand that you should look to collect one of your benefits early, because what happens in a widow situation, you can actually file for one and the other one will continue to grow. So there should be math done on it if you are eligible to receive. Now, you're still subject to everything I talked about. So you're eligible to collect the widow's benefit at 60, but if you're making too much money, you can't collect it, right? Or it could be reduced. But you also understand that we want to understand which is the bigger benefit. If my spouse's benefit at age full retirement because they passed away earlier is going to be the biggest, then I want to try to collect mine at 62, and at 67 switch to the survivor benefit. If my benefit's going to be higher, I want to collect my widow's benefit as soon as I can, and at age 70, I'm going to switch to that maximum credit or thereabouts after to have the higher benefit for the rest of my life. So there are some little bit of things just to be cognitive of with that. You had to have been married for at least 9 months. Here's the other thing. If you were divorced and you did the 10 years and the ex passes away, you go from 50 to 100%. So I always tell everybody, your names are all registered with the police department after we leave here tonight. If there's any exes that show up missing, they check with you first. No, but in all seriousness, a lot of people don't realize that if your ex passed away, you would be eligible for 100%, right? So keep that in mind if you're in that situation. And then you have to remain unmarried till age 60. Don't ask me why, but after age 60, you can find love again. But before then, do not remarry because you lose the benefit of it, okay? It's one of those quirky rules. I don't know why, but after 60, you can get married again. If you get married at 59, you lose the widow benefits. So that was part of the bipartisan. So one of the things we want to talk about as we're going through this, I mentioned in the beginning, life expectancy has been one of the biggest challenges on the Social Security system because the odds of people living beyond life expectancy dramatically increase once we both reach age 65. There's a 25% chance that one of you will live well into the 90s. And we're seeing that a lot with our clients now. You know, people are coming in, medicine is keeping them alive a lot longer. People have a lot more avenues to take better care of themselves. And that is all things that you have to plan for. And that's generally one of the fears that keep people from enjoying themselves during the go-go years. So creating a plan that will consider that will help you feel more comfortable about spending your dollars. But that might be some of the things we address with the timing of collecting your Social Security. So there's a 50% chance, now this again is once you guys reach age 65, there's a 50% chance that one of you will reach the age of 92, right? There's a 10% chance that somebody will make it to age 100. We have a client that, I don't want to jinx it, might be 100 next year. So we told them, you know, I don't even want to jinx it. You know, we're going to have a party when they turn 100, you know, with it. But it's just you're seeing that as a reality now with it. So a couple of things. There's a do-over reset. If you came in here and you're one of the people that raised their hand about Social Security, or if you know somebody that just filed for Social Security, if it was within 12 months, you can request a withdrawal of application. You have to pay it back, but it would be as if you never collected Social Security. We did that on a couple of different cases with clients because they didn't realize what they didn't know, right? So you can withdraw and start over. The stop, start, restart I mentioned to you already. Let's say you started your benefits earlier, realize that that's not the best way to create your plan, or you want to do some tax planning. Because some of the tax planning, once you start collecting Social Security, there's a marginal cost for taxes. You basically make every distribution out of your 401ks likely more expensive from a tax standpoint. So you realize that, say, hey, maybe full retirement, I'll suspend it and I'll do some conversions, let my Social Security grow, pay a standard rate instead of a marginal rate on taxes, and get things out cheaper. Understand that the current tax code is scheduled to sunset this year. So this is the friendliest tax code we've had in decades. Right? You can get all the way up to $400,000 of a joint income and still be paying 24% or less in your tax implications. If they don't extend it, this is what I believe they're going to do. I believe they're going to extend it because if they don't, it's political suicide for both parties. If they don't extend it, we revert back to the old tax code for 26. If that happens, everybody in this room likely is going to experience quite a bit of tax hikes. You're going to pay a lot more in taxes, you know, with it. So the tax planning aspect could be part of what this strategy would involve. You know, let's pay at the standard rate, not the marginal cost when it comes to it. Everybody's situation is different. I've hinted at that already. I just want you to kind of think a little bit more about what could Social Security address as some of my concerns? What are some of the things I need to be thinking about? And I mentioned one with me is like, you know, my wife. I want to make sure that she has a high promise-based income for the rest of her life, which would lend me to delaying collecting. Now, that's not everybody's main concern. Some of the other concerns can be across a wide array of things. Tax planning. Tax planning is a big component for us because taxes, I don't think, are going to go down. I think they're going to extend this tax code because I don't think Congress is going to be able to come up with a new tax code by year end. And I don't think they want to revert back, but the time is limited to have this big of a tax planning opportunity. In this code, you can do a lot of tax planning. So obviously understanding your income needs, what you anticipate they'll be in retirement, and then how do you close the gap? I told you before I'm not a big budget fan, but I think it's a good exercise to kind of understand, hey, what's the core? Because the reason we do that is the go-go, slow-go, and no-go. If we can take care of the no-go years from a standpoint of expenses adjusted for inflation, it might tell us how we can inflate some of the spending in the early years, right? But I like lifestyle planning. You know, what's your lifestyle? Easy way to look at people, well, how do I start? Look at your situation today. What income do you have coming in? What's hitting the checking account every month? And then at the end of the month, what's happening? If you're breaking even, that is your lifestyle need right now. There'll be things that could impact it. Insurance, I might have an insurance cost, so that means my lifestyle need would go up if I retire and I don't have it being taken on my check anymore. Mortgage could go away, which means my lifestyle need would go down in terms of the dollar amount. But that's the area we like to focus on. What is it that will allow you to retire and continue to do the things that you want to do? And then how do you close those gaps? There's a lot of different things. There's pros and cons to everything that you look at. A lot of people have the traditional retirement accounts, the 401ks, the 403bs. These are awesome plans. Young people call me today and they say, can I invest with you? I says, do you have a 401k? Do they match it? Do it. Because it's so advantageous to get free money, right? And you're not paying an advisor. I tell you, you don't need to pay an advisor during your accumulation phase. Pay an advisor when there's planning being done. Wealth management is not overly complicated. Most people understand that if I have risk appetite, market goes up, I'm going to make money, market goes down, I'm not going to look at my statement for 3 months, right? I mean, that's just the way things go. But we want to make sure the planning of it and the timing, and we eliminate things like sequence risk, mitigate taxes, create more predictability. That's when there's a lot of value. The cons, you still have the cons with those of understanding lost market risk. And I would say it's more about emotions, with it and understanding the timetables. But then here's the thing, is the taxation. As you accumulate these monies, what were we told for years? Invest these accounts till when? Till when you're retired. And then what's supposed to happen in retirement? Taxes are supposed to be less, right? Let me let you in a little secret. That there's not a different tax code for retired people. The only way you pay less in taxes is if you have no money. If you have money, you are going to pay taxes in retirement. So we need to plan for it. That was a fallacy. The Secure Act 2.0, some of the things, the biggest takeaways, RMDs. Everybody know what required minimum distributions are? When you reach a certain age, you have to take money whether you want it or not. And this is another thing that I always tell people about conversions. When you do conversions, you reduce required minimum distributions. Because required minimum distributions, they want you to take the money out. Why? They want you to pay taxes, right? You said you were going to use it for retirement. You're age 73. You're retired. You need to start using it. We want to make Social Security taxable. We want to pay you more taxes so we have more income. They're phasing that to 75 in 2033, so some of you in the room will not quite be 73, but it's 73 right now. They reduced the penalty to 25%. Used to be 50% if you didn't take it out, plus taxes on 100% of it. Yeah, so you would lose 65, 70% of it if you didn't take it out timely. There's catch-up provisions in the 401ks, defined contribution plans. Defined benefit pension plans, they're great. My dad had a pension. My dad has passed away. He passed away this last May, but his pension was continuing for Mom, and Mom's very comfortable on the pension. So pensions are awesome because they're a defined benefit. Market goes up, Ma gets a check. Market goes down, Ma gets a check, right? The challenge is, you don't have any say in the way they're constructed, and not everybody has them available. But one of the biggest challenges once you're collecting that, especially Mom now, I explained to her, this is the last year you're going to get a refund at your withholdings. Because when she files next year, she's going to file as a widow. And by the way, one of the questions I ask every couple that comes in my office, what's your plan when the first spouse passes away? Now, I ask that question because we all agree that that's a win event, right? That's not something that might happen. Right? That's going to happen. And when that happens, what happens in that situation? 3 things, right? Income goes down because you're going to lose one of your Social Security incomes. We already talked about that. How does a widow file? Single tax filer. I ran it for my mom. This year she's going to get a substantial refund. Next year she's going to owe about $300. Same withholdings, same income, same everything, but she's not going to file a joint return. She's going to be filing a single return. What generally happens with expenses? They go up, right? Just because you're not feeding a second person doesn't mean expenses are going to go down. Utility doesn't go in half. Mortgage payments don't go in half. Garbage and water doesn't go in half. The guy doesn't cut half your lawn, right? These are all things that still have to be taken care of at the same level. So these are things that you need to understand that, and I got off track of this particular slide, but it just brings up a moment of mine when we're developing the plans. Investments, non-qualified investments. This is probably one of the biggest areas that often frustrate people because you're in non-qualified investments. When do you find out about the tax ramifications of non-qualified assets? Sometime in March, right? And then in March, you got to bring them your brokerage, your composite 1099, and then they tell you, by the way, you had $20,000 of capital gains. Am I out of battery?
Nope, you're fine. But Wade Parker, if you could come out to the main area of the library, you have a phone call.
So when you get these things, they go onto your tax return and cause impacts, right? So you can't change any of that. So when you're non-qualified, they can be very positive. You can have control. You can do things like tax loss harvesting, you can control the taxable events, but if they're not set up properly, they can also be very, very inefficient. But they're a great asset. They're a better asset than your IRAs, your traditional IRAs, because they're preferential treatment. Capital gains are treated differently, dividends are treated differently, but we also need to understand how to control them. And I'm not going to get into that today. Annuities, we use annuities a lot for folks that like promise-based income. I generally don't use a wide array of annuities. There's some value to them. I think the biggest value is if you want insurance, right? If you want insurance, you want guaranteed income, you want promise-based income, they can do a very good job of providing that for you. If you're more comfortable with the market and the volatility and the risks, you can avoid using them if you want, but they can be very, very powerful for people that just want that consistency, that paycheck every month, with it. And eliminating some of the market risk. Life insurance, if you have it, don't just get rid of it. A lot of people say you have some cash value, you'll just sell it and get rid of it. Life insurance can be a very effective part of your planning process in that it can provide a lot of tax-free benefits. You can take those monies out tax-free, or you can 1035 exchange them into a contract and capture any cost basis and provide tax savings. If you've had a life insurance for a long period of time, and there's not a lot of cash value, you can 1035 that into another insurance instrument, and then all your gain from that point forward is tax-free because you're recapturing cost basis. If you cash it out, you just get the money, and it's a loss of assets. So all these assets, the biggest thing I tell people is all assets are not treated equal. So as you're beginning, and Social Security is an asset. So as you're beginning to enter this phase, it's about, okay, what are my main concerns, priorities, goals? What do I want to address? And what are some things that I need to think about to create efficiencies, right? Reduce taxes, reduce market volatility, create more predictable outcomes to provide more confidence in your planning process. And that's when it begins, right, with the planning aspect. Our process is pretty simple. We take people through 4 steps. First step is what we call a discover, where it's more about an in-depth of what your situation is. Goals, concerns, priorities, risk appetite, resources. Second step is what we call a design. We're going to look to create efficiencies, reduce taxes, create more predictable outcomes, provide opportunities for proper time horizons, eliminate sequence of return risk, talk about how Social Security can become part of that, and create a more efficient distribution plan for you. And the third step is basically to deliver, implementing everything and putting it in place. And once you become part of our organization, whether you do everything with us or not, we handle it. I started a tax practice because I told you the industry doesn't allow tax. Anybody ever ask a financial advisor tax advice? What do they tell you? Right, they're not qualified. Go talk to your tax professional. How many people do their own tax return? Do you know you're your own tax professional? Because that's it, right? That's your tax professional. Doesn't make it bad, but here's the thing. Most people's tax professionals are prepared. Preparers are what we call the historian. The preparer is going to look backwards, right? It's a balancing of the books is what a tax return is. Did you pay enough in where you don't know? If you paid too much, we're going to give you some back. When you look at planning, it's a more proactive look. Where are the opportunities to potentially reduce taxes in the future? And then the ongoing management is the most critical part of it. So we can still do preparation, but it's the planning aspect that can provide value. We're moving forward with it. So that's why we started a tax practice. We also have a Medicare practice. Medicare is becoming a very difficult landscape because they're talking about eliminating advisors in that area, and they're going to make you guys decide everything you should do when it comes to the type of plan and the type of prescription plan you should use. It's going to be a disaster. It really is, with it, because people don't know. We have attorneys that we work closely with, some in the legal, wills, trusts, some in the legacy planning, some in the asset protection planning. We have insurance professionals, we do wealth management, we do Social Security maximization. Everything is under one roof. Why? Because most people look at things in silos. And when you look at things in silos, they have a professional, they have somebody who handles their wealth, they have somebody who handles their taxes, they have somebody who handles their insurances. But those people don't talk amongst themselves on your behalf. And so having the understanding of impact of all those things affords us the opportunity to eliminate gaps in the planning process and create more efficiencies. And the fourth step is just our ongoing process, which is our dedicated service, and that's where tax management comes in. Anybody know how many tax law changes we've had in the last 5, 6, 7 years? More than we had in my first 25 years in this industry. Things are going to change, with every new administration. What does that mean to you? What are the things you should be doing? How do you want to be proactive? That's why planning is so important, why engagement with the right person can create a lot of value. I think I went late. I apologize. Hopefully you guys enjoyed it and you felt it worth the time. I think it is, I don't even know what time it is. I only went 11 minutes over. That's not too bad. Question?
In the event of a divorce, if the ex-spouse has remarried, will it affect the percentage that I
Nope.
feel entitled to?
Nope.
And is it confidential?
What you're getting, yes. You just go, let me wrap it up and I'll answer your question. So guys, if you would, there's a questionnaire in your books. Please fill that out. We have to do that in a non-for-profit environment. If you didn't like what I had to say, just go ahead and say you liked it anyways. Okay? No, if you want to have an opportunity to chat with me or one of the other advisors, there's some spots on the bottom that will indicate times that you can schedule a phone call with myself or likely Casey where we can answer any individual questions that you have, where we can get more specific about your situation. And then you can have the opportunity to ask us questions about us, how we engage, how our processes work. Grab a book on your way out, the Bucket Plan book. The Bucket Plan is the process we use. Jason Smith, the author, is a business partner of mine. He's out of Cleveland, Ohio. It's a very sound principle practice that we use to eliminate sequence of return risk and create more predictability in the outcome. It's a fable. It's not a heavy read. I'm not a big reader. Just talks about a couple going into retirement and some of the things you need to be thinking about. So go ahead, feel free to grab it. If you want to schedule a time, Colleen could potentially help you tonight with it, or you could go ahead and just indicate the time. Just tell her the best way to get a hold of you during the day, because she's out late tonight on a school night, but usually she goes home at a decent hour. So just let her know how she can contact you, okay? Thank you, guys.